All right, guys, welcome back for another video. In today's video, I want to talk about central bank liquidity swap operations and specifically the New York Fed central bank liquidity swap operations and tie it into the parabola on the DXY chart, the dollar index chart. Now, I know I've been talking about the dollar index parabola for a while, the one starting back in May 2021, leading up all the way to Q4 of 2022, so over a year. But I do think that the central bank liquidity swap operations may give people, a fundamental basis for why, the shift occurred in Q4 of 2022. People are always looking for a reason, and of course there are a multitude of reasons. Um, I made this post here on Twitter in Q4 of 2022. The Federal Reserve injected an aggregate of $27 billion into the foreign banking sector, spread across roughly 24 central bank liquidity swap operations. And that's when the dollar currency index, broke its parabola. Was that a coincidence? Probably not. Now, if we go to the Federal Reserve Bank of New York central bank liquidity swap operation, you can see all the different liquidity swap operations that have occurred during Q4. Now, if you just go to this website, anybody can go to it. It's public information. The link's actually in the Twitter post right here. But if you first go to this, it'll only show you the trades that have occurred in like the last week or so. So generally there's only one of these per week. So like if you went, you probably only see this one on January 4th. You need to expand the date range, to encompass all of Q4. And then you'll see the whole list. But I've done that here. I've expanded the date range from the start of the fourth quarter of 2022, October 1st, all the way to the last day. Actually, the last day of December 2023. So it's actually including this trade on January. This is the first trade of the new quarter, but everything else within this search is within the fourth quarter criteria. And you can see that mostly it's to the European Central Bank, but there are some transactions with the Swiss National Bank. Actually, the largest transaction was with the Swiss National Bank on October 20th for 11 billion. So of the 27 billion aggregate, 11 billion was on this one singular transaction. Now, this is total speculation, but people might be familiar with Credit Suisse having issues. This transaction may be related to that. Because broadly speaking, when you see these central bank liquidity operations, generally they're bailing out some aspect of whatever respective banking sector they're issuing to. If it's in Switzerland, the Swiss National Bank. If it's in the Eurozone, any bank dealing with euros, it's going to be through the European Central Bank. And of course, anyone dealing with yen is going to be through the Bank of Japan. Now, Credit Suisse had an incredible amount of issues, particularly in quarter four. So I wouldn't be surprised if this was related to that. Now, remember, the Fed can't give money directly to a private bank like Credit Suisse. It has to go through the Swiss National Bank and then be distributed through their respective central bank. Now, that's total speculation. I actually don't know what this was used for, but that's just one theory. And that's the type of thing that these operations are used for. Now, everybody's familiar with the collapse of FTX. Well, in the crypto industry, putting the fraud aside, if you have a large entity like that becomes insolvent and is so big that it poses systemic risk to that market. A lot of times, what you'll have is these central banks will bail out that entity, and that's constantly happening, especially in a period like right now, where things obviously aren't great for a lot of financial institutions, and they need bailouts. And so, rather than let the problem reach a crisis and have to bail out the entire banking sector with trillions of dollars all at once, they've found that it's generally better to bail out them one by one as they fall and basically paper over the problem as it happens rather than waiting to act until you have a systemic issue. And that's kind of reflective of the fact that, the entire banking system, not just domestically in the US, but like globally, is intertwined in a sense that the Fed has an interest in helping out, the the eurozone banks, not just the ECB, but private banks in Europe, because if, for example, you were to have a crisis in the European bond market, say potentially, countries withdrew from the European Union, issued new currencies, and defaulted on their euro-denominated debt, that would cause not just a crisis in the European banking sector, but the rest of the world too, right? I mean, in that sense, the eurozone is too big to fail, and I think these credit swap operations kind of reflect that. Now, these individually are definitely not very large. Even in the aggregate, right, the 27 billion, if you add up all of these over roughly 24 transactions, it's still, 27 billion used to be enough to turn eyes, but nowadays you can just send 27 billion and nobody really cares. Um, but definitely something to keep an eye on, because if these numbers start to exponentially accelerate, then that's something you definitely want to know about, because it does reflect a surge in USD liquidity, particularly internationally. Um, Not necessarily domestically, at least at first, right? I mean, the dollar market is a global market, and if you inject dollars internationally, eventually it will circulate back into the U.S. But that process takes a period of time. So if you can identify it um, earlier, that's definitely the better scenario. Now, this is interesting because the Fed is, well, they have a stance of tightening monetary policy currently, um, but when they're injecting U.S. dollar liquidity into foreign banking sectors, they can say with plausible deniability that they're still restricting, the dollar liquidity domestically, even though they're expanding it internationally, right? So the Fed effectively has two separate policy arms. They have international policy and domestic policy, and the domestic policy can be restrictive, while the international policy can be, loosening as far as financial conditions go. And that kind of ties itself into the kind of what's going on geopolitically with your fraction between the East, represented by Russia and China, and the war in Ukraine, and basically a lot of other countries that maybe aren't necessarily the strongest allies with America, being forced to choose sides. Do they want cheap cheap energy from Russia and everything that goes with that, or do they want national security protection from America? You know, uh, Countries that aren't strong allies with America have to make that decision. But countries that have a history of being strong allies with America don't really have that choice to make, right? They're kind of forced into the role of not trading with Russia and being an ally of America. And in that case, in order for them to do things that don't serve their economic interests, like for example, with Japan or the Eurozone, to not trade with Russia, which obviously it would be in their interest to get cheap energy as opposed to expensive energy. If you want them, the allies to, hold the line essentially in that capacity of doing things that aren't in their best interest economically, um, you have to do something for them, and that may take the form of, injecting dollars into their economies to help them out when they need help. Um, Particularly if the crisis is caused by the stance they're being told to take relative to the energy markets. But that's kind of a topic in itself, and I just really wanted to draw your attention to this page of the New York Fed, just something to keep an eye on, and kind of tie it into the dollar currency index, right? Because um, now, if you were to expand the search history before October 1st, you would see that basically there were a few operations, but they really picked up in Q4, pretty dramatically so. Now, again, it's only 27 billion in aggregate, but there basically wasn't any on this entire run up until Q4, and that's when the parabola broke. Now, you don't necessarily need central bank liquidity swap operations for a parabola to break. Every parabola blows off eventually, right? It can't continue its run exponentially indefinitely. But this is interesting nonetheless. And, I think sometimes things like this happen and we don't realize it until hindsight. It's very difficult to know exactly what to focus on, especially when, people, on Twitter are talking about interest rate hike cycles like it was, 2021, November 2021. A lot of these people who, are talking about uh, rising interest rates now weren't talking about it a year ago when the information was new and important, right? So whenever you're, analyzing the market and trying to create an investment thesis, you want to avoid looking in the review mirror at the things that have already impacted the market and try to focus on things that are upcoming and things that are out on the horizon, particularly further than a lot of people may necessarily be projecting out into the horizon. I found that generally the market tends to price in information that's roughly 6 to 10 months out. Um, so a lot of the things, for example, just to put that in perspective, um, a lot of what's happening in the market now is actually a reflection of what the market thinks, the state of the world will be like at the end of Q3 of 2023 of this year. That's kind of, in my experience, how far out on the horizon that the market tends to project. And if you can project further out than that, just briefly, I mean, you don't want to get too far out on the curve, but if you can, be even a little bit further out, then there's a lot of alpha out there. And particularly, you know, I guess the suggestion could be boiled down to the idea that, you know, do you think interest rates will be lower at the end of 2020 or 2023 or higher, right? Uh, Rather than necessarily trying to focus on what will happen in, or what, especially what has happened, but or what has happened will happen at the next FOMC meeting. Whereas a lot of the possibilities there are already priced in, so it's not really possible to trade that information. And especially, waiting for the next FOMC meeting and trading that information in live time is going to be particularly ineffective, right? I mean, if it, because at that point the information is fully priced into the market, and there's just nothing you can really do with it, right? It's not valuable anymore. So anyway, I hope you guys like this video. If you guys do like this type of content, just make sure to subscribe to the channel. I'll catch you guys in the next upload.